Are you afraid of the current bear market and trying to figure out which stocks to buy today? Or maybe you're struggling to decide between buying the Twitter stock, Tesla, or Google. Regardless of the case, in this video, we're going to teach you how to make money and be a winner during a stock market crash, diversifying your portfolio.
Are you familiar with the phrase, "Don't put all your eggs in one basket"? What about this one? Diversification of investments across asset classes is crucial to risk mitigation.
This is likely the piece of advice that you'll first hear whenever you're venturing into the world of investing. The reason why diversification is stressed so much is because it keeps giving you money over a certain period consistently without any sort of strings attached. We're sure that you may have heard of the cliche of "don't put all your eggs into one basket." And as we all know, it's due to the fact that if you lose the basket, you lose all your eggs. And it's no different in the stock market too. For example, let's say that you used all of your money to buy shares in a tech stock because you had believed it would continue to soar upward. Shortly after you bought the stock though, it gets completely obliterated, and suddenly you end up losing 10% of your savings. While this is an unfortunate reality for the unprepared and beginners, it's extremely easy to avoid. There are several markets outside of the stock market that can help you to diversify your financial portfolio during a stock market crash, which we'll talk about throughout the video. However, the best advice when it does come to portfolio diversification in the stock market is to make sure that you don't invest more than 5% of your account into one single sector. Just in case you don't know, a sector in the stock market is a group of companies that are in a similar line of business. For example, Facebook, which is Meta, Microsoft, and more are part of the technology sector. And when you divide your capital in sectors, you'll always limit your losses in case that specific sector crashes and burns forever. Investing in hard metals.
So gold has actually recently hit an 11-year high, trading at just above $1,900 an ounce. Some people are saying that this is due to endless money printing, as this shirt suggests. Some people are saying that it's a sign of a weakening, debasing US dollar.
Sometimes taking the tried and true approach is the best. Because when it comes to stock markets crashing in the past, investors often flock to gold and silver. The reason is because all currencies use these as a benchmark currency, and it's basically the same thing as using pounds as a measurement of weight. Now, while currencies aren't compared to any more of these hard metals, it's still a valuable asset nonetheless, especially in times of financial difficulty. This is due to the fact that gold and silver tends to be kept the same around the value that it normally has been for hundreds of years, regardless of how volatile the market may be. So, if you're wondering how to invest in these, we'll show you two ways. The first is to actually buy a physical gold or silver block and have it stored within a bank. The other way is to take advantage of mining company stocks, ETFs, and mutual bonds. Most people will opt for the stock option simply because it's much easier, but also you don't have to spend for storage and insurance. Paying off your debts.
We can use the debt snowball to accelerate our debt payoff and finally have some breathing room so we can get our head above water and take a big, deep breath.
We realize that this might seem a bit out of place, but it's actually an extremely effective method so as to make sure that you come out on top during a stock market crash. Typically, most stocks will fall during a market crash, even if some are more resilient than others. So, instead of taking the simple buy and hold strategy, it might be a good opportunity to sell your assets and pay off any remaining debts that you have. This way, not only will you get the benefit of collecting your earnings from the sales, which will still be a good price, you'll also leave off the stress that comes with the negativeness of a crashed market, like inflation. One word of caution though about this method is to try to remember that you'll be taxed on your capital gains as if it were a source of income. So make sure that you're using a tax-free savings account or to at least take into consideration when you're filing your taxes. Regardless, it's better to be safe than sorry. Take a shot at hedging.
When we hedge an investment, we reduce or eliminate certain risks that could negatively impact our holdings, including, but not limited to, stock market crashes as a whole.
Isn't hedging for investors with really deep pockets? To be honest, doesn't have to be. If you're someone who owns a margin account with your broker, then you can hedge the same way that a brokerage would hedge. The act of hedging is simply taking a profit from a market downturn. The way that hedging works is the exact opposite of what you would normally do in the stock market. Instead of buying into a stock that you expect to go up, you will sell the stock expecting it to go down. If you're confused how this works, then don't worry, let me explain. Going short on a stock is simply the act of borrowing shares from a company, selling the shares, and then buying them back at a much lower price. Your broker would then pay you the simple difference between the first sell price and the price at which you bought the shares back. Since you only borrowed the shares from the bank, think of it like a loan, you'll be returned the shares at a lower price by contract that they will have to pay you the difference for. Now, while this is a great way to maximize your profit gain from the stock market, it is not for the faint of heart. And neither is it for beginner investors, because you definitely can't talk to your brokerage or anyone who manages your finances. Are you enjoying this video so far? Then please give it a like and subscribe to the channel, and also don't forget to ding that notification bell so you don't miss out on our latest videos. Find the treasure in Treasury bonds.
If you're looking for a way to invest your money right now, but you aren't yet comfortable with the idea of investing in the stock market due to the volatility, I-bonds are a great way to start.
These are undoubtedly some of the steadiest investments that you can find, and you know what steady means during a bear market, right? It means that you'll always be a winner. Treasury bonds are an investment vehicle that is 100% backed by the US government, and in fact, they are the ones who actually funded them in the first place. So, investors will often be found having some account of their capital safety tucked into Treasury bonds. When you own a Treasury bond, you're paid a valuable interest rate that usually is somewhere between 1 to 3%, although the number can be greater, on the amount that you own until the bond matures. Typically, they are maturing with a minimum of 10 years from their actual issue date and go down to around 30 years. Obviously, this is a long-term investment, but hey, it's one that's by far one of the best ways to deal with a stock market crash. Do it right with REITs.
With home prices soaring and reaching all-time highs since the pandemic, and with bidding wars even cropping up in almost every single state with many homes going over their list price, the question then becomes, how can we invest in real estate if we don't have the money to put down a down payment on a house?
Have you ever wanted to get into real estate, but just didn't have the financial means to do so physically in buying properties? Well, REITs might solve that problem. REITs, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate. While you can buy these through a broker, they're not exactly a stock. REITs don't typically follow the stock market due to the fact that the companies are based in real estate and aren't entirely affected by the same economic movements that many companies are. On top of their security during a crash, they also pay solid dividends that always have a huge bonus whether the market is barreling out or not. Do absolutely nothing.
Buy and hold strategy. Now, this is a strategy I would recommend for most part-time investors, people who are saving for their retirement or to have passive income in the future.
You heard it right, folks. Sometimes the best thing you can do is nothing during a stock market crash. Seriously, it sounds so simple. This method is known as the buy and hold strategy, so let me explain real quick. Over the past century, there have been several bear markets. Now, if you were to look at any given market over the past 100 years, then you'll no doubt see an impressive rise. The important thing to know about the stock market and the economy in general is that it is cyclical. There are times whenever the economy is very strong and times when it's just not. So, if you're worried about your investments burning away, just remember that stocks don't go down forever. Look for some value buys.
Guys, the important part here is to buy stocks at a value that makes sense. You will never, ever, ever buy at the exact bottom, and you will never, ever, ever consistently sell at the top.
Believe it or not, there is a way to take advantage of a rapidly dropping price in a company, but you need to be very brave. The way this strategy works is that you'd actually buy shares of a stock whenever it's heading down. Now, while this may seem contrary to logic, it's actually not the case. Let us explain real quick. If you were to buy into a solid blue chip company, would you want to buy it at $100 per share or $80 per share? Well, the most likely answer would be the cheaper one. Now, if you're worried that the stock will end up going down further and you lose your money, it's important to remember that the market crashes don't go on forever. At this same time, if you end up buying a blue chip company, then it's likely to have survived plenty of crashes and still came out on top. Cycle your shares into reliable sectors.
The process of doing that is called sector rotation. The process is finding stocks and, more importantly, finding industry groups that are moving, industry groups that the smart money.
Sometimes the media makes it seem like it's impossible to make money during a bear market. While we do agree it's very difficult for businesses, it's definitely not impossible to make money. There's times whenever certain sectors perform extremely well during a market crash, and these sectors are usually companies that are tied to necessities for us to live. If you're uncertain of what these sectors might be, then you need to ask yourself the question, what do I need to buy to live every day? You're probably going to come up with answers like food, water, gas in your car, and so forth and so on. Just to further strengthen our point, during the stock market crash, energy and oil are doing extremely well. Another important point to think about is that sectors which tend to do really well during a bull market are things like technology, which usually go down quite a bit during a bear market. So, cycling sectors is a great way to win during a stock market crash. Dividend investing. Dividends are your friends.
Dividend investing. So investing into dividend stocks, it's something that's been around for quite some time, but something that you can consider taking advantage of in order to earn some extra cash on a monthly basis. So
that's true. Dividends are always your friends. Whether the market is booming upwards or crashing downwards, you can always rely on dividends to keep giving you money back. Simply put, dividends are extra points and profits from a company that are paid out to the shareholders. This means that you owe shares in a company that pays dividends, and that can expect them to pay you money as a thanks for your investment. Dividend payments usually range from about 2 to 6% per share and are typically paid quarterly, once every 3 months. Stable dividends are usually paid by companies known as blue chip companies, and these companies have withstood the test of time and have taken several stock market crashes and lived to see another day. What this should tell you is that these companies are reliable and trustworthy. You can be certain that your money is safe with them. If you want to learn more about dividend investing during a stock market crash, be sure to check out our video, Dividend Investing During a Stock Market Crash.